Question 1. The monitoring system demonstrates a significant increase in alerts related to unusual trading patterns across several client accounts. These alerts range from minor deviations in trading frequency to more substantial spikes in volume and value for specific securities. The firm's risk assessment framework requires a systematic approach to evaluating these alerts to determine appropriate action. Which of the following represents the most appropriate initial risk assessment approach? Option A. Prioritize investigation based on the severity of the anomaly and the potential impact on the firm and its clients, considering factors such as the size of the trades, the frequency of the unusual activity, and the client's profile. Option B. Focus solely on the number of alerts generated by the system, allocating resources to investigate the accounts with the highest alert volume. Option C. Dismiss alerts related to minor deviations in trading frequency, as these are likely to be normal client behavior. Option D. Immediately escalate all alerts to the compliance department for a full review, regardless of the perceived magnitude of the anomaly. Correct answer is A. Prioritize investigation based on the severity of the anomaly and the potential impact on the firm and its clients, considering factors such as the size of the trades, the frequency of the unusual activity, and the client's profile. Explanation: this scenario is professionally challenging because it requires the financial professional to balance the need for proactive risk identification with the practical constraints of resource allocation and the potential for generating false positives. The core of the challenge lies in determining the appropriate level of scrutiny for identified anomalies without causing undue disruption or missing critical risks. Careful judgment is required to distinguish between minor deviations and significant indicators of potential fraud, market manipulation, or regulatory breaches. The correct approach represents best professional practice because it prioritizes a systematic and evidence-based methodology for risk assessment. By focusing on the severity and likelihood of the identified anomalies, and by considering the potential impact on the firm and its clients, the professional is adhering to the principles of sound risk management. This aligns with regulatory expectation that firms have robust systems in place to identify and mitigate risks. Specifically, this approach would be consistent with the principles of risk-based supervision and the need for proportionate responses to identified risks, ensuring that resources are directed towards the most critical areas. An incorrect approach that focuses solely on the volume of alerts without considering their nature or potential impact fails to conduct a proper risk assessment. This could lead to wasted resources investigating trivial matters, potentially masking more serious issues. Ethically, it demonstrates a lack of diligence and a failure to exercise professional judgment. Another incorrect approach that immediately escalates all alerts without any initial triage is inefficient and can overwhelm compliance teams, leading to a desensitization to alerts and a higher chance of missing genuine risks. This also fails to meet the regulatory expectation of a risk-based and proportionate response. An approach that dismisses alerts based on a superficial understanding of the underlying transactions, without further investigation, represents a significant ethical and regulatory failure, potentially allowing illicit activities to go undetected and exposing the firm to severe penalties. Professionals should employ a decision-making framework that begins with understanding the nature of the alert. This involves gathering context, assessing the potential severity and likelihood of the risk, and considering the potential impact. Based on this assessment, a tiered approach to investigation and escalation should be implemented, ensuring that resources are used effectively and that the most significant risks receive the most attention. This process should be documented and subject to periodic review to ensure its continued effectiveness. Question 2. Regulatory review indicates that a financial advisor is working with a client who has expressed a strong desire to invest a significant portion of their portfolio in a highly speculative, illiquid asset class that carries substantial risk of capital loss. The client is adamant about this allocation, citing anecdotal evidence and personal conviction. Despite the advisor's assessment that this allocation is inconsistent with the client's stated long-term financial goals and risk tolerance, the advisor's primary regulatory obligation is to ensure that all recommendations and actions taken are in the client's best interest and are suitable for their circumstances. Which of the following approaches best aligns with the advisor's regulatory and ethical responsibilities in this situation? Option A. Inform the client that their request cannot be fulfilled due to regulatory restrictions and suggest they seek advice elsewhere if they insist on this type of investment. Option B. Proceed with the client's requested investment allocation without further discussion, as the client has the ultimate authority to direct their investments. Option C. Execute the client's requested investment immediately to avoid upsetting the client and potentially losing their business, while making a mental note to monitor the investment closely. Option D. Strongly advise the client against the speculative investment, clearly outlining the risks and unsuitability based on their profile, and present alternative, more suitable investment options that align with their stated goals. Document the discussion and the client's final decision. The correct answer is B. Proceed with the client's requested investment allocation without further discussion, as the client has the ultimate authority to direct their investments. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preferences and the advisor's fiduciary duty to act in the client's best interest, particularly when those preferences might lead to suboptimal outcomes or increased risk. The advisor must navigate the complexities of client autonomy versus regulatory obligations, ensuring transparency and suitability without being unduly influenced by the client's potentially misinformed desires. The challenge lies in providing objective advice while respecting the client's right to make final decisions, all within the strict confines of regulatory compliance. Correct approach analysis. The correct approach represents best professional practice because it prioritizes the client's best interests, a cornerstone of fiduciary duty and regulatory compliance under the specified framework. This approach involves a thorough assessment of the client's financial situation, risk tolerance, and investment objectives. Crucially, it requires educating the client about the potential risks and downsides of their preferred investment, offering suitable alternatives that align with their stated goals, and documenting the entire process, including the client's informed decision. This ensures transparency, suitability, and adherence to the principle of acting with due care and diligence, thereby fulfilling regulatory requirements and ethical obligations. Incorrect approaches analysis. An approach that blindly follows the client's instruction without due diligence fails to uphold the fiduciary duty. It neglects the regulatory requirement to ensure that investments are suitable for the client's circumstances and risk profile, potentially exposing the client to undue risk or unsuitable products. This constitutes a regulatory failure by not performing adequate client assessment and suitability checks. An approach that dismisses the client's preferences outright without proper explanation or exploration of alternatives, while perhaps well-intentioned, can be perceived as paternalistic and may damage the client relationship. While the advisor has a duty to advise, disregarding client input entirely without a clear, documented rationale based on suitability and risk can lead to a perception of not adequately considering the client's stated wishes, potentially creating a compliance issue if the client later claims their preferences were ignored without justification. An approach that prioritizes generating commission or fees over the client's best interest, even if superficially appearing to follow the client's request, is a direct violation of ethical and regulatory standards. This demonstrates a conflict of interest and a failure to act solely in the client's best interest, leading to significant regulatory and ethical breaches. Professional reasoning. Professionals should adopt a structured decision-making process that begins with a comprehensive understanding of the client's profile and objectives. This is followed by an objective assessment of investment suitability and risk. When a client's preference deviates from this assessment, the professional must engage in open and transparent communication, clearly explaining the rationale behind their recommendations and the potential implications of the client's preferred course of action. The process must be thoroughly documented, capturing all discussions, advice provided, and the client's final, informed decision. This systematic approach ensures that client interests are paramount, regulatory obligations are met, and ethical standards are maintained. Question 3. Compliance review shows that a new client, operating a business in a sector identified as having a moderate risk of money laundering, has provided a significant portion of the required identification documents for account opening. However, the client has requested to commence transactions immediately, citing an urgent business need, and has promised to provide the remaining documents within 48 hours. The compliance officer is considering allowing the transactions to proceed under this assurance. Option A. The compliance officer should proceed with account opening and allow all transactions, assuming the client's stated business need is genuine and the sector risk is only moderate. Option B. The compliance officer should allow the client to commence transactions immediately, relying on the client's promise to provide the remaining documents within 48 hours. Given the moderate risk rating of their business sector, Option C. The compliance officer should allow limited transactions to proceed, with a cap on the transaction value, while awaiting the remaining documents as a gesture of goodwill. Option D. The compliance officer should insist on receiving and verifying all required identification documents before allowing any transactions to commence, regardless of the client's urgency. The correct answer is D. The compliance officer should insist on receiving and verifying all required identification documents before allowing any transactions to commence, regardless of the client's urgency. Explanation. Scenario analysis. This scenario presents a challenge in balancing the need for robust internal controls with the practicalities of client onboarding and ongoing relationship management. The compliance officer must navigate the potential for regulatory breaches if procedures are not followed diligently, while also ensuring that the firm's operations are not unduly hampered by overly burdensome or inefficient processes. The core tension lies in interpreting and applying the Know Your Customer, KIC, and anti-money laundering, AML, obligations in a way that is both effective and proportionate. Correct approach analysis. The correct approach demonstrates a commitment to upholding the firm's regulatory obligations by ensuring that all required documentation is obtained and verified before the client relationship is fully established. This aligns with the principles of customer due diligence, CDD, as mandated by relevant anti-money laundering regulations. Specifically, it ensures that the firm has taken reasonable steps to identify the client, understand the nature of their business, and assess the risks associated with the relationship. This proactive stance minimizes the risk of facilitating financial crime and protects the firm from potential regulatory sanctions and reputational damage. It reflects a culture of compliance and a commitment to responsible business practices. Incorrect approaches analysis. One incorrect approach fails to recognize the critical importance of obtaining and verifying identification documents. This directly contravenes the fundamental requirements of KYC and CDD, exposing the firm to significant risks of facilitating money laundering or terrorist financing. Such a failure constitutes a serious regulatory breach, potentially leading to fines, sanctions, and reputational harm. Ethically, it represents a dereliction of duty to protect the integrity of the financial system. Another incorrect approach, while seemingly efficient, bypasses essential verification steps. This creates a loophole that could be exploited by individuals seeking to launder illicit funds. The absence of proper verification means the firm cannot confidently assert that it knows its customer, a cornerstone of AML compliance. This approach prioritizes speed over security and regulatory adherence, leading to a high risk of non-compliance and associated penalties. A third incorrect approach demonstrates a misunderstanding of the ongoing nature of AML obligations. While initial due diligence is crucial, the risk profile of a client can change over time. Failing to periodically review and update client information, especially for high-risk clients, leaves the firm vulnerable to evolving threats and can be considered a failure to maintain adequate ongoing due diligence. This can result in a loss of awareness of potentially suspicious activities, leading to regulatory scrutiny. Professional reasoning. Professionals in this field must adopt a risk-based approach to compliance. This involves understanding the specific regulatory requirements, assessing the inherent risks associated with different client types and transactions, and implementing controls that are proportionate to those risks. A robust decision-making process would involve 1. Identifying the relevant regulatory obligations, e.g., AML, KIC, CDD. 2. Assessing the risk profile of the client based on available information. 3. Determining the appropriate level of due diligence required for that risk profile. 4. Ensuring that all necessary documentation is collected and verified according to established procedures. 5. Documenting the due diligence process and any decisions made. 6. Establishing mechanisms for ongoing monitoring and review of client relationships. 7. Seeking clarification from senior management or legal/compliance departments when in doubt. Question 4. Stakeholder feedback indicates that the proposed automation of a key client onboarding process, while promising significant cost reductions, has raised concerns regarding potential impacts on client experience and data security. The firm is considering how to proceed with evaluating these potential consequences. Option A. Focus the evaluation solely on the projected cost savings and efficiency gains, assuming that any negative impacts on client experience or data security will be minor and manageable post-implementation. Option B. Prioritize the immediate implementation of the automation to realize cost savings quickly, deferring any detailed assessment of client experience or data security until after the system is live. Option C. Conduct a comprehensive impact assessment that systematically evaluates the potential effects on client satisfaction, operational efficiency, data integrity, regulatory compliance, and overall business risk, developing mitigation strategies for identified negative impacts. Option D. Initiate a limited review of the automation's impact, primarily addressing the most obvious technical challenges, and dismiss concerns about client experience and data security as subjective and less critical than operational efficiency. The correct answer is C. Conduct a comprehensive impact assessment that systematically evaluates the potential effects on client satisfaction, operational efficiency, data integrity, regulatory compliance, and overall business risk, developing mitigation strategies for identified negative impacts. Explanation. This scenario presents a professional challenge due to the inherent conflict between immediate operational needs and the long-term strategic implications of a proposed change. The firm must balance the desire for efficiency gains with the potential for unintended consequences that could impact client relationships, regulatory compliance, and overall business sustainability. Careful judgment is required to ensure that the impact assessment is comprehensive, objective, and considers all relevant stakeholder perspectives. The correct approach represents best professional practice because it mandates a thorough and systematic evaluation of all potential impacts, both positive and negative, across various dimensions. This aligns with the principles of responsible business conduct and robust risk management, which are implicitly or explicitly required by regulatory frameworks governing financial services. Specifically, a comprehensive impact assessment ensures that decisions are informed by a clear understanding of consequences, thereby minimizing the likelihood of regulatory breaches, ethical lapses, and reputational damage. It promotes proactive identification and mitigation of risks, fostering client trust and ensuring the long-term viability of the firm's operations. An incorrect approach that focuses solely on cost savings fails to acknowledge the broader implications of the proposed change. This represents a regulatory and ethical failure by potentially overlooking impacts on client service levels, data security, or operational resilience, which could lead to breaches of client duty or regulatory requirements related to operational risk. Another incorrect approach that prioritizes speed of implementation over thoroughness risks overlooking critical risks. This is a failure because it bypasses due diligence, potentially leading to noncompliance with regulations that require adequate risk assessment and control measures before significant operational changes are made. Furthermore, it can result in unforeseen operational disruptions or client dissatisfaction, which are also areas of regulatory concern. An approach that dismisses stakeholder concerns without proper investigation is ethically unsound and can lead to regulatory scrutiny. It demonstrates a lack of due diligence and a failure to engage with stakeholders whose interests are affected, potentially violating principles of fair dealing and transparency. Professionals should employ a decision-making framework that begins with clearly defining the scope and objectives of the impact assessment. This involves identifying all relevant stakeholders and potential impact areas, e.g., operational, financial, client, regulatory, reputational. The next step is to gather data and evidence through appropriate methodologies, followed by analysis of the identified impacts, including their likelihood and severity. Crucially, this analysis must inform the development of mitigation strategies for negative impacts and the optimization of benefits from positive ones. The final stage involves communicating the findings and recommendations to relevant decision makers and implementing the agreed-upon course of action, with ongoing monitoring and review. Question 5. Implementation of a new complex financial product is imminent, and the business unit is pushing for an immediate launch to capitalize on market opportunities. While internal testing has been conducted, a formal, comprehensive impact assessment, as typically required by regulatory guidelines for new product introductions, has not yet been completed. What is the most appropriate course of action to ensure compliance and protect client interests? Option A. Launch the product immediately to capture market advantage and initiate the impact assessment process post-launch. Option B. Proceed with the launch based on the positive results of internal testing and anecdotal feedback from a limited internal group. Option C. Rely on the existing risk management framework to cover any potential issues, as a formal impact assessment may be overly burdensome. Option D. Conduct a thorough impact assessment, including client impact, market integrity, and operational risks, before proceeding with the product launch. Correct answer is D. Conduct a thorough impact assessment, including client impact, market integrity, and operational risks, before proceeding with the product launch. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between the immediate need for a new product launch and the regulatory requirement for a thorough impact assessment. The pressure to meet market demands can lead to shortcuts, potentially exposing the firm and its clients to unforeseen risks. The complexity lies in balancing business objectives with compliance obligations, requiring a nuanced understanding of the CCDE trademark written exam, V2. 1. Syllabus, specifically regarding impact assessment principles. Correct approach analysis. The correct approach involves conducting a comprehensive impact assessment prior to the product launch. This aligns with the principles of responsible financial innovation and client protection mandated by the regulatory framework governing the CCDE trademark written exam, V2. 1. A robust impact assessment identifies potential risks to clients, market integrity, and the firm itself, allowing for mitigation strategies to be implemented before the product is made available. This proactive stance is crucial for maintaining client trust and adhering to regulatory expectations for due diligence and risk management. Incorrect approach is analysis. Launching the product without a formal impact assessment, relying solely on internal testing, represents a significant regulatory failure. This bypasses the structured risk identification and mitigation processes required by the regulatory framework. It demonstrates a disregard for client welfare and market stability, potentially leading to breaches of conduct rules. Proceeding with the launch based on anecdotal feedback from a small group of internal stakeholders, without a systematic assessment, is also a regulatory and ethical lapse. This approach is subjective and lacks the rigor necessary to identify systemic risks or unintended consequences that could affect a broader client base. It fails to meet the standard of due diligence expected under the regulatory framework. Delaying the impact assessment until after the product has been launched and issues arise is a reactive and unacceptable approach. This indicates a failure to adhere to the principle of proactive risk management. It exposes clients to potential harm and the firm to regulatory sanctions for noncompliance with pre-launch assessment requirements. Professional reasoning. Professionals should adopt a risk-based approach, prioritizing regulatory compliance and client protection. When faced with pressure to expedite a launch, the decision-making process should involve 1. Identifying the regulatory requirements for new product introduction, specifically the need for impact assessments. 2. Evaluating the potential risks associated with the new product, considering client impact, market integrity, and operational feasibility. 3. Determining the appropriate level of assessment required based on the product's complexity and potential risk profile. 4. Communicating the findings of the assessment and any necessary mitigation strategies to relevant stakeholders, including senior management and compliance departments. 5. Ensuring that the assessment is completed and reviewed before the product is launched. Question 6. The risk matrix shows a potential, albeit low probability, breach of a specific reporting regulation that could result in a moderate financial penalty if discovered. The internal audit team has flagged this as a potential issue requiring further investigation, but the immediate financial impact on the firm appears negligible. What is the most appropriate course of action for the firm's senior management? Option A. Disregard the finding as the probability is low and the immediate financial impact is negligible, focusing resources on higher priority risks. Option B. Initiate a formal investigation involving legal and compliance departments to thoroughly assess the nature and extent of the potential breach, document findings, and determine appropriate remediation steps. Option C. Immediately pay the potential moderate financial penalty to proactively resolve the issue and avoid further scrutiny. Option D. Conduct a quick internal review by the audit team to confirm the low probability and then close the matter without external consultation. The correct answer is B. Initiate a formal investigation involving legal and compliance departments to thoroughly assess the nature and extent of the potential breach, document findings, and determine appropriate remediation steps. Explanation. This scenario presents a professionally challenging situation because it requires balancing the immediate financial implications of a potential regulatory breach against the long-term reputational damage and the ethical obligation to uphold compliance standards. The CCDE Trademark Written Exam, V2. 1. Syllabus emphasizes the importance of a structured decision-making framework when faced with complex ethical and regulatory dilemmas. The challenge lies in moving beyond a purely transactional view of compliance to one that integrates risk management, ethical considerations, and the firm's overall integrity. The correct approach represents best professional practice because it prioritizes a thorough, documented investigation into the potential breach. This aligns with the principles of due diligence and responsible conduct expected of financial professionals. By engaging legal and compliance teams, the firm demonstrates a commitment to understanding the full scope of the issue, assessing its regulatory implications, and formulating a response that is both compliant and ethically sound. This proactive and structured approach minimizes the risk of further violations, protects the firm's reputation, and ensures adherence to the spirit and letter of relevant regulations. An incorrect approach that focuses solely on the immediate financial cost of a potential fine fails to acknowledge the broader consequences of regulatory noncompliance. This approach is ethically deficient as it prioritizes short-term financial gain over long-term integrity and stakeholder trust. It also carries significant regulatory risk, as a superficial or delayed response could lead to more severe penalties and sanctions. Another incorrect approach, which involves ignoring the potential breach due to its perceived low probability, demonstrates a failure in risk assessment and a disregard for the firm's compliance obligations. This is a direct violation of professional duty, as all potential regulatory issues, regardless of perceived likelihood, must be investigated. This approach exposes the firm to significant legal and reputational damage if the breach is later discovered. A further incorrect approach, which involves attempting to rectify the issue internally without involving legal and compliance, is also professionally unacceptable. This can lead to an incomplete or inadequate remediation, potentially creating new compliance issues or failing to address the root cause of the problem. It bypasses established governance structures designed to ensure robust compliance and ethical conduct. Professionals should employ a decision-making framework that begins with identifying the potential issue, assessing its materiality and regulatory implications, consulting with relevant internal stakeholders, legal, compliance, risk management, and then developing a documented plan of action. This framework emphasizes transparency, thoroughness, and adherence to established regulatory and ethical standards. Question 7. Operational review demonstrates that client onboarding procedures, while designed to align with the firm's stated risk appetite, are exhibiting a pattern of expedited approvals for certain client segments, potentially bypassing some standard due diligence checks. Option A. Initiate a targeted review of the specific onboarding processes and staff involved to identify the root cause of the expedited approvals and implement necessary corrective action, including enhanced training or procedural adjustments, to ensure alignment with the firm's risk appetite and regulatory obligations. Option B. Immediately halt all client onboarding for the affected segments until a comprehensive overhaul of the entire onboarding system can be completed. Option C. Reevaluate and significantly lower the firm's stated risk appetite to accommodate the observed onboarding practices, thereby formalizing the current operational reality. Option D. Issue a general reminder to all staff about the importance of adhering to onboarding procedures, without investigating the specific reasons for the observed deviations. The correct answer is A. Initiate a targeted review of the specific onboarding processes and staff involved to identify the root cause of the expedited approvals and implement necessary corrective actions, including enhanced training or procedural adjustments, to ensure alignment with the firm's risk appetite and regulatory obligations. Explanation. Scenario analysis. This scenario presents a challenge because the operational review has identified a potential conflict between the firm's established risk appetite and the observed client onboarding practices. The core difficulty lies in balancing the need for efficient client acquisition with the imperative to adhere to regulatory requirements designed to prevent financial crime. A hasty or incomplete response could lead to regulatory sanctions, reputational damage, and a failure to uphold ethical standards. The decision-maker must navigate the gray area between policy interpretation and practical implementation. Correct approach analysis. The most appropriate approach involves a thorough, evidence-based investigation into the root cause of the discrepancy. This includes reviewing the specific client onboarding procedures, assessing the training and understanding of the staff involved, and evaluating the effectiveness of existing controls. If the review confirms that practices are deviating from the stated risk appetite and potentially increasing compliance risk, the next step is to implement targeted remediation. This might involve revising procedures, enhancing training, or adjusting resource allocation to ensure compliance with the firm's risk appetite and relevant regulations, such as those pertaining to anti-money laundering (AML) and Know Your Customer (KIC) requirements. This aligns with the principle of maintaining robust internal controls and a strong compliance culture, which is a fundamental expectation under regulatory frameworks. Incorrect approaches analysis. One incorrect approach would be to dismiss the findings as minor operational inefficiencies without further investigation. This fails to acknowledge the potential for systemic issues and the serious regulatory consequences of noncompliance with AML/KYC obligations. Demonstrates a disregard for the firm's stated risk appetite and a lack of due diligence, which could be interpreted as a failure to implement adequate controls. Another incorrect approach would be to immediately implement drastic, broad-brush changes to the onboarding process without understanding the specific nature of the deviation. This could disrupt legitimate business operations, negatively impact client relationships, and may not address the actual root cause of the problem. It also suggests a reactive rather than a proactive and analytical approach to risk management. A third incorrect approach would be to solely focus on the financial cost of implementing new controls or training, without adequately weighing this against the potential financial and reputational costs of regulatory breaches. This prioritizes short-term cost savings over long-term compliance and risk mitigation, which is a significant ethical and regulatory failing. Professional reasoning. Professionals should employ a structured decision-making framework that begins with a clear understanding of the identified issue. This involves gathering all relevant facts, assessing the potential risks and impacts, and considering the applicable regulatory and internal policy requirements. The framework should then guide the selection of the most appropriate course of action, prioritizing solutions that are both effective in addressing the issue and compliant with all obligations. This process emphasizes a balanced consideration of operational efficiency, risk management, regulatory adherence, and ethical responsibilities. Question 8. System analysis indicates that a financial advisory firm is experiencing significant client onboarding delays due to its current risk assessment process. The firm's compliance department is under pressure to streamline this process to improve client acquisition rates. The firm operates within a jurisdiction that mandates a risk-based approach to client due diligence. Which of the following approaches to risk assessment best balances regulatory compliance with operational efficiency? Option A. Discontinue the formal risk assessment process for client onboarding to expedite the process, relying solely on general background checks. Option B. Implement a tiered risk-based assessment system that categorizes clients based on identified risk factors and applies enhanced due diligence for high-risk clients, while maintaining a streamlined process for lower-risk clients. Option C. Apply a uniform, low-level risk assessment to all prospective clients to ensure a consistent and rapid onboarding experience for everyone. Option D. Mandate an exceptionally rigorous and time-consuming risk assessment for every single client, irrespective of their perceived risk profile, to err on the side of extreme caution. The correct answer is B. Implement a tiered risk-based assessment system that categorizes clients based on identified risk factors and applies enhanced due diligence for high-risk clients, while maintaining a streamlined process for lower-risk clients. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent tension between the need to maintain robust risk assessment processes and the pressure to expedite client onboarding. The firm's reputation and regulatory standing are at stake if risk assessment is compromised. The complexity arises from balancing the need for thorough due diligence with the practicalities of client acquisition in a competitive market. A superficial risk assessment could lead to significant financial and reputational damage, while an overly burdensome process might deter legitimate clients. Correct approach analysis. The correct approach involves a tiered risk-based assessment that prioritizes high-risk clients for more intensive scrutiny. This aligns with the principles of effective risk management and regulatory expectations. By segmenting clients based on identified risk factors, e.g., source of funds, business activities, geographic location, the firm can allocate resources efficiently. This approach ensures that the most significant risks are adequately identified and mitigated, while low-risk clients can proceed with a streamlined process, thereby balancing efficiency with compliance. This is best professional practice as it demonstrates a proactive and proportionate approach to risk management, adhering to the spirit and letter of regulatory guidance on anti-money laundering and counter-terrorist financing. Correct approaches analysis. Applying a uniform, low-level risk assessment to all clients, regardless of their profile, is a significant regulatory and ethical failure. It fails to identify and mitigate higher risks, potentially exposing the firm to illicit activities and contravening the principle of know your customer. Kick. This approach is a direct violation of risk-based regulatory frameworks that mandate a differentiated approach to due diligence. Implementing an overly stringent and time-consuming risk assessment for every client, even those with demonstrably low risk profiles, is also professionally unacceptable. While appearing cautious, this approach is inefficient, can lead to unnecessary client attrition, and may not be proportionate to the actual risks presented. It can also be seen as a failure to implement risk-based controls effectively, as it does not differentiate based on risk. Ignoring client risk factors entirely and proceeding with onboarding without any form of risk assessment is a grave regulatory and ethical breach. This demonstrates a complete disregard for compliance obligations and exposes the firm to severe penalties, reputational damage, and potential involvement in financial crime. It is a direct contravention of fundamental anti-money laundering and counter-terrorist financing regulations. Professional reasoning. Professionals should adopt a decision-making framework that begins with understanding the firm's risk appetite and regulatory obligations. This involves identifying potential risk categories relevant to the business, such as client type, product complexity, and geographic exposure. Subsequently, a risk-based methodology should be developed to assess and categorize clients. This methodology should include clear criteria for determining risk levels and corresponding due diligence measures. Regular review and updating of this methodology are crucial to adapt to evolving risks and regulatory changes. When faced with client onboarding, professionals must apply this framework consistently, ensuring that the level of due diligence is proportionate to the assessed risk. Question 9. What factors determine the appropriate level of customer due diligence, CDD, to be applied to prospective clients under the UK's regulatory framework for financial crime prevention? Option A. The firm's internal marketing targets for client acquisition and revenue generation. Option B. The client's stated preference for a simplified onboarding process to expedite service delivery. Option C. The volume of new clients the firm aims to onboard within a given financial quarter. Option D. The perceived risk associated with the client, considering factors such as their business type, geographical location, and the nature of the intended business relationship, in line with a risk-based approach. The correct answer is D. The perceived risk associated with the client, considering factors such as their business type, geographical location, and the nature of the intended business relationship, in line with a risk-based approach. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a firm's desire to expand its client base and the stringent regulatory requirements designed to prevent financial crime. The firm must navigate the complexities of customer due diligence, CDD, and anti-money laundering, AML, obligations, without unduly hindering legitimate business opportunities. The challenge lies in striking a balance between robust compliance and operational efficiency, ensuring that the firm does not become a conduit for illicit funds, while also not creating insurmountable barriers for potential clients. The need for careful judgment arises from the subjective nature of risk assessment and the potential for misinterpretation of regulatory guidance. Correct approach analysis. The correct approach emphasizes a risk-based methodology for CDD. This aligns directly with the principles of the UK's money laundering regulations, MLR, and the Financial Conduct Authorities, FCA guidance. A risk-based approach allows firms to allocate resources effectively, focusing enhanced due diligence (ED) on high-risk clients and transactions, while applying simplified due diligence (SDD) where appropriate and permitted. This is best professional practice because it is mandated by regulation, promotes efficiency, and is more effective in identifying and mitigating money laundering risks than a one-size-fits-all approach. It demonstrates a commitment to regulatory compliance and ethical conduct by proactively addressing potential vulnerabilities. Incorrect approach is analysis, an approach that mandates the same level of enhanced due diligence for all prospective clients, regardless of their risk profile, is professionally unacceptable. This fails to adhere to the risk-based principles of the MLRs and FCA guidance. It is inefficient, creates unnecessary barriers for low-risk clients, and can lead to a dilution of focus on genuinely high-risk individuals or entities. Ethically, it can be seen as a failure to act with due diligence in a proportionate manner. Another incorrect approach would be to rely solely on readily available public information for all clients without considering the specific nature of the business relationship or the client's jurisdiction. This approach ignores the potential for sophisticated money laundering schemes that may not be immediately apparent from public sources. It violates the spirit and letter of the MLRs, which require firms to understand their clients and the purpose of the business relationship, especially for higher-risk scenarios. Finally, an approach that prioritizes speed of onboarding over thoroughness of CDD, particularly for clients in sectors known to be higher risk for money laundering, is a significant regulatory and ethical failure. This demonstrates a disregard for the firm's AML obligation and exposes the firm to substantial legal and reputational risks. It directly contravenes the FCA's expectations for robust AML controls. Professional reasoning. Professionals should adopt a decision-making framework that begins with a thorough understanding of the relevant regulatory obligations, specifically the UK's MLRs and FCA AML handbooks. This involves assessing the inherent risks associated with different client types, geographical locations, and business activities. The firm should then develop and implement clear internal policies and procedures that reflect a risk-based approach to CDD. Regular training for staff on these policies and on identifying red flags is crucial. Furthermore, ongoing monitoring of client activities and periodic reviews of CDD information are essential to ensure continued compliance and to adapt to evolving risks. This systematic approach ensures that compliance is integrated into business operations rather than being an afterthought. Question 10. When evaluating the potential consequences of a proposed major network upgrade that involves replacing core routing hardware and implementing a new quality of service (QoS) policy across the enterprise, which impact assessment approach best ensures a comprehensive understanding of all ramifications? Option A. Conducting a detailed technical analysis of the new hardware specifications and the proposed QoS configuration, focusing on performance metrics and compatibility with existing network devices. Option B. Initiating a phased implementation of the new hardware and QoS policy in a lab environment, followed by a pilot deployment in a non-critical segment of the production network, while simultaneously engaging with business unit leaders to understand their service level expectations and potential disruptions. Option C. Performing a broad, high-level assessment of the project's timeline and budget with a cursory review of potential technical challenges. Option D. Relying on vendor documentation and pre-sales engineering reports to validate the functionality and expected performance improvements of the new equipment and QoS features. The correct answer is A. Conducting a detailed technical analysis of the new hardware specifications and the proposed QoS configuration, focusing on performance metrics and compatibility with existing network devices. Explanation. This scenario presents a professional challenge because it requires a Cisco-certified professional to navigate the complexities of a significant network infrastructure change, while adhering strictly to the principles of impact assessment as defined by the CCDE trademark written exam, V2. 1. Syllabus. The challenge lies in identifying the most comprehensive and systematic method to understand the ramifications of the proposed change, ensuring minimal disruption and maximum benefit. The professional must balance technical feasibility with business continuity and security considerations, all within the implicit regulatory and best practice framework of the CCDE certification. The correct approach represents best professional practice because it embodies a structured, multifaceted methodology for understanding the full scope of a proposed change. It prioritizes a thorough understanding of the existing environment, the potential impacts across various domains, technical, operational, business, and the development of mitigation strategies. This aligns with the CCDE emphasis on designing and implementing complex networks by considering all relevant factors, thereby ensuring a robust and resilient network. It reflects a proactive stance, aiming to prevent issues before they arise, which is a cornerstone of professional network engineering. An incorrect approach that focuses solely on the immediate technical implications of the change fails to consider the broader operational and business impacts. This could lead to unforeseen downtime, security vulnerabilities, or a failure to meet business objectives, violating the principle of designing for business needs. Another incorrect approach that prioritizes speed over thoroughness risks overlooking critical dependencies or potential conflicts, leading to cascading failures and significant remediation efforts. This demonstrates a lack of due diligence and a disregard for the potential negative consequences. An approach that neglects to involve relevant stakeholders, such as business unit representatives or security teams, is also professionally unacceptable. This failure to collaborate can result in solutions that do not meet business requirements or introduce unacceptable security risks, highlighting a deficiency in communication and a lack of holistic problem solving. The professional decision-making process for similar situations should involve a systematic approach. 1. Define the scope and objectives of the change. 2. Identify all affected systems, services, and users. 3. Assess the potential impact on performance, availability, security, and business operations. 4. Engage with all relevant stakeholders to gather input and validate assumptions. 5. Develop a comprehensive plan that includes rollback procedures and contingency measures. 6. Document the entire process and communicate findings to all parties. Question 11. The audit findings indicate that a senior executive who has significant personal investments in a particular technology sector has been actively involved in the strategic decision-making process for a subsidiary that is planning a major acquisition within that same technology sector. The executive has not formally disclosed this personal financial interest to the board or relevant committees. What is the most appropriate course of action for the executive and the company? Option A. The audit findings should be disregarded as they pertain to personal investments, and the executive should continue their involvement in the strategic decision-making process as usual. Option B. The executive should verbally acknowledge their interest to the head of the subsidiary's acquisition team and proceed with their involvement, trusting their professional judgment to remain objective. Option C. The executive should delegate their decision-making authority on this matter to a trusted subordinate, who will then make the final decision without further consultation with the executive. Option D. The executive must immediately disclose their personal financial interest to the board of directors and recuse themselves from all discussions and decisions related to the subsidiary's acquisition. The board should then establish an independent committee to oversee the acquisition process. The correct answer is D. The executive must immediately disclose their personal financial interest to the board of directors and recuse themselves from all discussions and decisions related to the subsidiary's acquisition. The board should then establish an independent committee to oversee the acquisition process. Explanation. The audit findings indicate a potential conflict of interest arising from a senior executive's involvement in a subsidiary's decision-making process where their personal investments are significantly exposed. This scenario is professionally challenging because it requires balancing the executive's fiduciary duties to the parent company with their personal financial interests. The core tension lies in ensuring that decisions made are solely in the best interest of the parent company, free from undue personal influence, and that all relevant stakeholders are treated fairly. The complexity is amplified by the need to maintain transparency and uphold the company's ethical standards and regulatory compliance. The correct approach, which involves recusal from decision-making and disclosure of the conflict, represents best professional practice because it directly addresses the identified conflict of interest in a transparent and ethical manner. This aligns with fundamental principles of corporate governance and fiduciary duty, which mandate that individuals in positions of trust must act in the best interests of the entity they serve. Regulatory frameworks, such as those governing corporate conduct and financial markets, often require disclosure of such conflicts and may mandate recusal to prevent self-dealing or decisions that disadvantage the company or its shareholders. This approach ensures objectivity and maintains stakeholder confidence. An incorrect approach that involves proceeding with the decision after a brief verbal acknowledgement of the conflict fails to adequately mitigate the risk. This is a regulatory and ethical failure because it does not provide sufficient assurance that the decision will be impartial. The potential for subconscious bias remains, and the lack of formal documentation or recusal leaves the company vulnerable to accusations of impropriety and potential breaches of duty. Another incorrect approach, which is to ignore the audit findings and continue as before, represents a severe regulatory and ethical failure. It demonstrates a disregard for internal controls, audit processes, and ethical conduct. It exposes the company to significant legal and reputational risks, including potential sanctions for non-compliance with corporate governance regulations, and a breakdown of trust with investors and other stakeholders. A further incorrect approach, which is to delegate the decision-making solely to a subordinate without any oversight or formal conflict resolution process, is also professionally unacceptable. While it removes the executive from direct decision-making, it fails to address the underlying conflict of interest and may lead to decisions that are influenced by the executive's known personal interest through indirect communication or pressure. This approach lacks accountability and transparency. Professionals should employ a structured decision-making framework when faced with potential conflicts of interest. This typically involves 1. Identification of the potential conflict, 2. Assessment of the severity and potential impact of the conflict, 3. Consultation with relevant internal policies, legal counsel, and compliance departments, 4. Determination of appropriate mitigation strategies, which may include disclosure, recusal, divestment of interests, or independent review. 5. Documentation of the conflict and the chosen course of action. 6. Implementation and ongoing monitoring of the chosen strategy. This systematic approach ensures that decisions are made ethically, legally, and in the best interests of the organization. Question 12. The control framework reveals a critical system vulnerability requiring immediate remediation. While the urgency to deploy a fix is high to prevent potential data breaches and service disruptions, the established policy mandates a formal impact assessment for any system change that could affect client data or operational continuity. The IT team proposes an immediate deployment of a patch developed by a third-party vendor, citing the critical nature of the vulnerability and the potential for significant client impact if left unaddressed. Which of the following actions best aligns with the regulatory framework and professional best practices in this scenario? Option A. Initiate a formal impact assessment process, engaging relevant stakeholders to evaluate the potential effects of the vendor patch on systems, processes, client data, and regulatory compliance, while simultaneously exploring interim measures to mitigate immediate risks. Option B. Rely on the vendor's assurance that the patch is thoroughly tested and secure, and proceed with deployment without further internal assessment, as the vendor bears primary responsibility for the patch's integrity. Option C. Delay the deployment of any patch until a comprehensive internal system audit can be conducted to identify all potential vulnerabilities and their interdependencies, ensuring a holistic security posture. Option D. Proceed with the immediate deployment of the vendor patch after a brief internal review by the IT security team, prioritizing operational continuity and client data protection by addressing the known vulnerability. The correct answer is D. Proceed with the immediate deployment of the vendor patch after a brief internal review by the IT security team, prioritizing operational continuity and client data protection by addressing the known vulnerability. Explanation. This scenario presents a professional challenge due to the inherent conflict between the immediate need for operational continuity and the regulatory imperative to conduct a thorough impact assessment before implementing significant changes. The pressure to restore service quickly can lead to shortcuts that bypass crucial risk identification and mitigation steps, potentially exposing the firm and its clients to unforeseen consequences. Careful judgment is required to balance urgency with compliance and robust risk management. The correct approach represents best professional practice because it prioritizes adherence to the established control framework and regulatory requirements. By conducting a comprehensive impact assessment, the firm demonstrates a commitment to understanding the potential ramifications of the proposed change on its systems, processes, client data, and regulatory obligations. This proactive approach allows for the identification of risks, the development of appropriate mitigation strategies, and ensures that the implemented solution is not only effective in restoring service, but also compliant and secure. This aligns with the principles of responsible financial conduct and client protection mandated by the regulatory environment. An incorrect approach that bypasses the impact assessment entirely represents a significant regulatory and ethical failure. It demonstrates a disregard for established governance procedures and a failure to adequately assess and manage risk. This could lead to breaches of data privacy regulations, operational disruptions due to unforeseen system incompatibilities, or even non-compliance with reporting requirements, all of which carry severe penalties and reputational damage. Another incorrect approach that relies solely on anecdotal evidence or the opinion of a single senior individual without a formal assessment fails to provide objective evidence of risk mitigation and compliance. This is ethically questionable as it places undue reliance on subjective judgment rather than a structured, evidence-based process, potentially overlooking critical risks that a formal assessment would uncover. The professional decision-making process for similar situations should involve a structured risk-based approach. When faced with an urgent operational issue requiring a change, the first step is to acknowledge the need for a change. Subsequently, the professional must immediately consider the regulatory requirements for implementing such changes, particularly those related to impact assessments. If an impact assessment is mandated, the urgency of the situation should be communicated to the relevant stakeholders to expedite the assessment process, not to bypass it. The decision-making framework should prioritize understanding the potential impact on all relevant areas, including regulatory compliance, client data security, operational stability, and business continuity. This structured approach ensures that decisions are informed, compliant, and aligned with the firm's risk appetite and ethical obligations. Question 13. The efficiency study reveals that the firm's current client onboarding process is resource-intensive. To streamline operations and reduce costs, management is considering a significant overhaul. Which of the following approaches best balances the need for efficiency with regulatory compliance and client service quality? Option A. Outsource the entire client onboarding function to a third-party vendor without conducting due diligence on the vendor's compliance procedures or data security protocols. Option B. Immediately reduce the number of staff involved in client onboarding by 30% to achieve immediate cost savings, assuming that existing staff can absorb the workload. Option C. Implement a fully automated digital onboarding system, eliminating the need for direct client interaction during the initial stages, and reallocate the saved personnel costs to marketing initiatives. Option D. Conduct a comprehensive impact assessment involving compliance, operations, and client relationship teams to identify potential risks and benefits across all affected areas, followed by a phased implementation with robust training and ongoing monitoring. Correct answer is C. Implement a fully automated digital onboarding system, eliminating the need for direct client interaction during the initial stages, and reallocate the saved personnel costs to marketing initiatives. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need for cost reduction with the long-term implications for client service quality and regulatory compliance. The pressure to demonstrate efficiency gains can lead to decisions that, while appearing beneficial in the short term, could undermine client trust and potentially violate regulatory expectations regarding service standards and record-keeping. Careful judgment is required to ensure that efficiency measures do not compromise the firm's fiduciary duties or its adherence to the principles of good conduct. The correct approach represents best professional practice because it prioritizes a holistic impact assessment that considers all relevant stakeholders and regulatory requirements. By engaging with compliance and operational teams, and by focusing on a phased implementation with clear communication and monitoring, the firm demonstrates a commitment to responsible change management. This aligns with regulatory expectations that firms should have robust processes for assessing and mitigating the risks associated with operational changes, ensuring that client interests remain paramount, and that all activities are conducted with integrity and due diligence. The emphasis on understanding the downstream effects on client interactions and data management directly addresses the need for ongoing service quality and regulatory adherence. An incorrect approach that focuses solely on immediate cost savings without a thorough impact assessment fails to acknowledge the potential for negative consequences. This could lead to regulatory breaches if, for example, reduced staffing impacts the ability to meet service-level agreements or to adequately supervise client interactions, which are often subject to regulatory oversight. Another incorrect approach that prioritizes technological solutions without considering the human element and the need for adequate training and support for staff could result in operational errors, data integrity issues, and a decline in client satisfaction, potentially leading to complaints and regulatory scrutiny. A third incorrect approach that bypasses internal compliance review risks, overlooking critical regulatory obligations related to client data, record retention, or the suitability of advice, thereby exposing the firm to significant compliance failures and reputational damage. Professionals should employ a decision-making framework that begins with a clear understanding of the objectives, followed by a comprehensive risk assessment that considers operational, client, and regulatory impacts. This should involve cross-functional collaboration, particularly with compliance and legal departments, to ensure all potential issues are identified and addressed. The implementation of any change should be phased, with clear metrics for success and ongoing monitoring to allow for adjustments. Communication with all affected parties, including clients where appropriate, is crucial for managing expectations and maintaining trust. Question 14. Benchmark analysis indicates that a significant portion of client portfolios are misaligned with their stated risk tolerance due to behavioral biases that emerge during periods of market volatility. As a financial advisor, what is the most appropriate course of action when you observe a client's investment behavior and emotional responses during a market downturn that starkly contradict their previously declared conservative risk profile? Option A. Continue to manage the portfolio according to the client's original conservative risk tolerance, assuming their stated preference is paramount and their current reactions are temporary. Option B. Initiate a thorough reevaluation of the client's risk tolerance, incorporating observations of their behavior during the downturn, their stated goals, and their understanding of investment risks, to determine if adjustments to the portfolio are necessary. Option C. Focus solely on the quantitative risk metrics of the current portfolio, assuring the client that the portfolio's statistical risk remains within their initially declared conservative parameters. Option D. Immediately rebalance the portfolio to a significantly more conservative allocation, overriding the client's initial stated risk tolerance based on your assessment of their current emotional state. The correct answer is B. Initiate a thorough reevaluation of the client's risk tolerance, incorporating observations of their behavior during the downturn, their stated goals, and their understanding of investment risks, to determine if adjustments to the portfolio are necessary. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated risk tolerance and their actual investment behavior, which often deviates significantly. The advisor must navigate this discrepancy to ensure the client's portfolio aligns with their true capacity and willingness to bear risk, thereby upholding fiduciary duties and regulatory compliance. The difficulty lies in identifying the root cause of the mismatch and implementing appropriate corrective actions without alienating the client or compromising professional judgment. Correct approach analysis. The correct approach involves a multifaceted assessment that goes beyond the client's self-declaration. It requires the advisor to actively probe for behavioral biases, past investment experiences, and the client's understanding of risk. By observing the client's reactions to market volatility, discussing their emotional responses to gains and losses, and reviewing their financial goals in conjunction with their current holdings, the advisor can form a more accurate picture of their true risk profile. This comprehensive approach aligns with regulatory expectations that advisors conduct thorough suitability assessments, ensuring that investment recommendations are appropriate for the client's circumstances, objectives, and risk tolerance. It demonstrates a commitment to acting in the client's best interest, a cornerstone of ethical conduct and regulatory frameworks governing financial advice. Incorrect approach is analysis. One incorrect approach involves solely relying on the client's initial stated risk tolerance, even when subsequent portfolio performance or client behavior suggests otherwise. This failure to reassess and adapt the risk profile based on evolving circumstances or observed biases constitutes a breach of the duty of care and suitability requirements. It can lead to investments that are either too aggressive, causing undue stress and potential losses, or too conservative, hindering the achievement of financial goals. Another incorrect approach is to dismiss the client's stated risk tolerance entirely and unilaterally impose a portfolio that the advisor deems appropriate, without adequate client engagement or explanation. This paternalistic stance disregards the client's autonomy and can erode trust. It also risks misinterpreting the client's true risk capacity, potentially leading to unsuitable recommendations and a violation of the principle of client-centric advice. A third incorrect approach is to focus exclusively on the quantitative aspects of risk, e.g., volatility metrics, without considering the qualitative factors, such as the client's emotional response to market fluctuations or their understanding of the underlying investments. This narrow focus can result in a portfolio that is statistically optimal but emotionally unbearable for the client, leading to impulsive decisions and a failure to meet the spirit of risk assessment. Professional reasoning. Professionals should employ a dynamic and iterative risk assessment process. This involves 1. Initial comprehensive assessment, gathering information on financial situation, goals, and stated risk tolerance. 2. Behavioral observation, monitoring client reactions to market events and investment performance. 3. Probing questions, engaging the client in discussions about their comfort levels with different scenarios and their understanding of risk. 4. Portfolio alignment, ensuring the investment strategy consistently reflects the refined understanding of the client's risk profile. 5. Regular review and adjustment, periodically revisiting the risk assessment and portfolio allocation to account for changes in the client's circumstances or market conditions. This structured approach ensures that advice remains suitable, ethical, and compliant with regulatory obligations. Question 15. The evaluation methodology shows that a network administrator is alerted to intermittent connectivity issues affecting a critical application hosted on a server cluster. Users report slow response times and occasional complete loss of access. The network segment serving this cluster includes several Cisco switches and routers, with a recent firmware upgrade applied to the core switch within the last 48 hours. The administrator has access to network monitoring tools that show elevated latency and packet loss on the uplink from the core switch to the distribution layer, but no other anomalies are immediately apparent. Which of the following approaches should the network administrator prioritize to diagnose and resolve this issue? Option A. Analyze the logs and performance metrics of the core switch and the affected server cluster, focusing on the uplink interface, to identify specific error messages or traffic patterns contributing to the latency and packet loss. Option B. Immediately revert the firmware upgrade on the core switch to its previous version and monitor for service restoration. Option C. Escalate the issue to the network engineering team, providing them with the initial monitoring data and user reports. Option D. Initiate a full network diagnostic sweep of the entire data center to identify any widespread network instability. The correct answer is B. Immediately revert the firmware upgrade on the core switch to its previous version and monitor for service restoration. Explanation. The evaluation methodology shows that a core competency assessed in the CCDE written exam, V2. 1. Is the ability to apply a structured approach to complex problem-solving within a Cisco-centric networking environment, adhering to best practices and relevant industry standards. This scenario presents a common challenge where a network engineer must diagnose and resolve a performance degradation issue without immediate access to all diagnostic tools or complete network visibility. The professional challenge lies in making informed decisions under uncertainty, prioritizing troubleshooting steps, and ensuring that proposed solutions do not inadvertently introduce new risks or violate established network policies. Careful judgment is required to balance the urgency of restoring service with the need for thoroughness and adherence to operational procedures. The correct approach represents best professional practice because it systematically isolates the problem by leveraging available information and progressively gathering more data. It begins with understanding the reported symptoms and the scope of the impact, then moves to verifying the most likely causes based on the network architecture and recent changes. This methodical process, often referred to as a top-down or divide-and-conquer strategy, minimizes disruption and efficiently identifies the root cause. It aligns with the principles of effective network troubleshooting, emphasizing data-driven decisions and a logical progression of tests. This approach is implicitly supported by general IT best practices and the operational guidelines expected of certified professionals, which prioritize service availability and stability. An incorrect approach that focuses solely on reconfiguring the most recently deployed segment without verifying its impact or considering other potential causes represents a failure to follow a structured troubleshooting methodology. This can lead to wasted effort, potential service disruption in other areas, and a delay in resolving the actual issue. It violates the principle of isolating variables and can be seen as a premature assumption of the root cause, which is professionally unsound. Another incorrect approach that involves immediately rolling back all recent configuration changes without a clear understanding of which change, if any, is the culprit, is also professionally unacceptable. This is a broad-stroke solution that can cause significant service disruption and may not even address the actual problem if it stems from an older configuration or an external factor. It demonstrates a lack of analytical rigor and a failure to apply targeted diagnostic techniques. A third incorrect approach that involves escalating the issue to a higher tier of support without performing any initial diagnostic steps is a failure to demonstrate due diligence and problem-solving capability. While escalation is a necessary part of the support process, it should be a last resort after reasonable troubleshooting efforts have been made. This approach can lead to unnecessary delays and increased costs, and it does not reflect the expected competency of a professional engineer. The professional decision-making process for similar situations should involve 1. Clearly defining the problem and its impact. 2. Gathering all available information, including logs, monitoring data and user reports. 3. Formulating hypotheses about potential causes. 4. Prioritizing hypotheses based on likelihood and ease of testing. 5. Systematically testing hypotheses, starting with the simplest and most probable. 6. Documenting all steps taken and findings. 7. Implementing a solution based on confirmed findings. 8. Verifying the resolution and monitoring for recurrence. Question 16. Process analysis reveals that a client who has been researching investment options independently approaches their financial advisor with a strong preference for a specific, complex structured product they have encountered. The client expresses confidence in this product's potential returns and has indicated they wish to invest a significant portion of their portfolio into it. The advisor has not yet conducted a detailed review of the client's current financial standing or risk tolerance for this specific engagement. Which of the following represents the most appropriate course of action for the financial advisor? Option A. Conduct a thorough assessment of the client's financial objectives, risk tolerance, and overall financial situation to determine if the preferred structured product is suitable, and if so, explain its suitability and any associated risks. Option B. Proceed with recommending the client's preferred structured product, as the client has expressed a clear desire and confidence in its potential. Option C. Inform the client that their chosen product is not suitable without conducting any further analysis based on the advisor's general knowledge of structured products. Option D. Prioritize the client's request and facilitate the investment into the structured product, focusing on the potential commission generated by the transaction. The correct answer is A. Conduct a thorough assessment of the client's financial objectives, risk tolerance, and overall financial situation to determine if the preferred structured product is suitable, and if so, explain its suitability and any associated risks. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference for a specific investment product and the advisor's fiduciary duty to recommend suitable investments based on the client's comprehensive financial situation and risk tolerance. The advisor must navigate the potential for misaligned incentives and the need for objective advice, even when faced with a client who believes they have already identified the optimal solution. The challenge lies in balancing client autonomy with regulatory obligations to act in the client's best interest. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing a thorough understanding of the client's financial objectives, risk tolerance, and overall financial situation before making any investment recommendations. This aligns with the core principles of client-centric advice and regulatory requirements that mandate suitability. By conducting a comprehensive assessment, the advisor ensures that any recommended product, including the one the client favors, is genuinely appropriate and not merely a product the client has heard about or is predisposed to. This proactive due diligence prevents potential harm to the client and upholds the advisor's fiduciary responsibility. Incorrect approaches analysis, recommending the client's preferred product without further investigation, fails to meet the suitability requirements. This approach disregards the advisor's obligation to assess the client's individual circumstances and could lead to an investment that is inappropriate, exposing the client to undue risk or failing to meet their financial goals. This constitutes a regulatory and ethical failure to act in the client's best interest. Proceeding with the client's preferred product solely because the client insists, without a proper suitability assessment, also violates the advisor's duty. While client preferences are important, they do not supersede the advisor's responsibility to ensure the investment is suitable. This approach prioritizes client satisfaction over client well-being and regulatory compliance. Focusing only on the potential commission or fees associated with the client's preferred product, without considering suitability, represents a severe conflict of interest and a breach of fiduciary duty. This approach prioritizes the advisor's financial gain over the client's best interests, which is a clear regulatory and ethical violation. Professional reasoning. Professionals should employ a structured decision-making process that begins with a comprehensive client discovery phase. This involves gathering detailed information about their financial situation, investment objectives, time horizon, and risk tolerance. Following this, a thorough analysis of potential investment options, including the client's preferred product, should be conducted against the backdrop of the client's profile. The advisor must then clearly articulate the rationale for any recommendation, explaining how it aligns with the client's best interests and regulatory requirements. Transparency and documentation of this process are crucial. Question 17. Process analysis reveals that a long-standing client, who has consistently expressed a conservative investment philosophy and a low-risk tolerance, is now insistent on investing a significant portion of their portfolio in a highly speculative, illiquid alternative investment product that has recently gained market attention. The client states they heard about it from a friend and believe it will offer rapid, substantial returns. As their advisor, you have reviewed the product's prospectus and find it carries substantial risks, including the potential for total loss of capital, and is not aligned with the client's established financial goals or risk profile. How should you proceed? Option A. Proceed with the investment as requested by the client to maintain the relationship and avoid potential conflict, assuming the client understands the risks involved. Option B. Inform the client that while the product is speculative, you can facilitate the investment if they sign a waiver acknowledging the risks, thereby absolving you of responsibility. Option C. Document a thorough discussion with the client outlining the specific risks and unsuitability of the product for their profile. Explore alternative investments that align with their stated goals, and if the client remains insistent on the unsuitable product, decline to execute the transaction while explaining the rationale based on regulatory suitability requirements. Option D. Execute the investment in the speculative product, but recommend a slightly smaller allocation than initially requested by the client, believing this mitigates some of the risk. The correct answer is C. Document a thorough discussion with the client outlining the specific risks and unsuitability of the product for their profile. Explore alternative investments that align with their stated goals, and if the client remains insistent on the unsuitable product, decline to execute the transaction while explaining the rationale based on regulatory suitability requirements. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the candidate to navigate a situation where a client's stated preference for a specific investment product conflicts with the advisor's assessment of the product's suitability and the client's overall financial objectives. The advisor must balance the client's autonomy with their fiduciary duty to act in the client's best interest, all within the strict regulatory confines of the CCDE trademark written exam, V2. 1. Jurisdiction. The pressure to meet sales targets or maintain client relationships can create a conflict of interest, demanding a robust decision-making framework. Correct approach analysis. The correct approach involves a thorough, documented discussion with the client about the risks and suitability of the preferred product, exploring alternative options that align better with their stated goals and risk tolerance, and ultimately refusing to proceed if the product remains unsuitable and the client cannot be persuaded. This aligns with the core principles of client-centric advice, emphasizing suitability, transparency, and the advisor's obligation to prioritize the client's financial well-being over immediate sales. Regulatory frameworks typically mandate that advice and product recommendations must be suitable for the client, considering their knowledge, experience, financial situation, and investment objectives. Documenting this process is crucial for demonstrating compliance and protecting both the client and the advisor. Incorrect approach is analysis. Proceeding with the client's preferred product without further discussion or due diligence is a significant regulatory and ethical failure. Breaches the duty of care and the suitability requirements, potentially exposing the client to undue risk and the advisor to disciplinary action. This approach prioritizes sales over client welfare. Accepting the client's preference solely to avoid conflict or maintain the relationship without adequately assessing suitability also constitutes a failure. It demonstrates a lack of professional judgment and a disregard for regulatory obligations. The advisor is not acting as a trusted professional, but as a mere order taker. Suggesting a slightly modified version of the unsuitable product without a fundamental reevaluation of its appropriateness for the client's specific circumstances is also problematic. It may be an attempt to circumvent the suitability rules without genuinely addressing the underlying issue, potentially leading to the same negative outcomes for the client. Professional reasoning. Professionals should employ a structured decision-making framework that begins with understanding the client's needs and objectives. This is followed by a rigorous assessment of product suitability, considering all relevant client factors and regulatory requirements. Any divergence between client preference and suitability assessment must be addressed through open communication, education, and the exploration of alternatives. If a consensus cannot be reached on a suitable course of action, the professional must be prepared to decline the business, prioritizing ethical conduct and regulatory compliance above all else. Documentation of all discussions and decisions is paramount. Question 18. The evaluation methodology shows that the firm's client onboarding process relies heavily on an automated system for initial risk assessment, with limited manual intervention for high-risk clients. The compliance officer is tasked with assessing the effectiveness of this methodology. Which of the following approaches best demonstrates a comprehensive and compliant evaluation? Option A. Verifying that documented policies and procedures for client onboarding are in place and accessible to relevant staff. Option B. Reviewing the cost-effectiveness of the automated onboarding system compared to manual processes. Option C. Assessing the speed and efficiency of the automated system in processing new client applications, focusing on turnaround times. Option D. Testing the actual implementation and effectiveness of the automated system, supplemented by manual review and enhanced due diligence procedures for high-risk clients, to ensure controls are proportionate to identified risks. The correct answer is D. Testing the actual implementation and effectiveness of the automated system, supplemented by manual review and enhanced due diligence procedures for high-risk clients, to ensure controls are proportionate to identified risks. Explanation. The evaluation methodology shows a critical need to assess the effectiveness of a firm's internal controls related to client onboarding and ongoing due diligence. This scenario is professionally challenging because it requires the compliance officer to move beyond a superficial review of documented procedures and delve into the practical application and effectiveness of these controls in preventing financial crime. The firm's reliance on a single, automated check without human oversight for high-risk clients presents a significant vulnerability, as automated systems can be circumvented or fail to identify nuanced risks. The correct approach represents best professional practice because it advocates for a multi-layered, risk-based evaluation that includes testing the actual implementation and effectiveness of controls. This aligns with regulatory expectations that firms not only have policies, but also demonstrate their practical application and their ability to adapt to evolving risks. Specifically, it emphasizes the need to assess whether the automated system is supplemented by appropriate human judgment and enhanced due diligence for high-risk clients, as mandated by regulations requiring robust Know Your Customer (KIC) and anti-money laundering (AML) procedures. This approach ensures that controls are not merely theoretical but actively mitigate identified risks. An incorrect approach that relies solely on the existence of documented policies without verifying their implementation and effectiveness is professionally unacceptable. This fails to meet regulatory requirements for ongoing monitoring and risk assessment, potentially leading to the firm being used for illicit purposes. Another incorrect approach that focuses only on the efficiency of the automated system, without considering its limitations in identifying complex or emerging risks, ignores the principle of proportionality and the need for controls to be commensurate with the risks faced by the firm. This can result in a false sense of security. An approach that prioritizes cost reduction over the adequacy of controls would be a direct violation of regulatory mandates to implement effective AML/CFT measures, as the cost of noncompliance far outweighs any short-term savings. Professionals should employ a decision-making framework that begins with understanding the firm's risk profile and the specific regulatory obligations. This involves not just reviewing policies, but actively testing their efficacy through sampling, interviews, and observation. The evaluation should then identify gaps between documented procedures and actual practice, and assess the impact of these gaps on the firm's risk exposure. Finally, recommendations should be actionable, risk mitigating, and aligned with regulatory expectations for a robust compliance program. Question 19. Process analysis reveals that a client, a rapidly growing technology startup, has expressed a strong desire for aggressive tax planning to minimize their current tax liabilities and reinvest profits. The client has provided a preliminary proposal that involves complex cross-border transactions and the utilization of offshore entities, which they believe is a common practice in their industry. As a trusted advisor, what is the most appropriate course of action to ensure both client satisfaction and regulatory compliance? Option A. Immediately implement the client's proposed offshore structure and cross-border transactions, as the client has indicated it is a common industry practice and believes it to be legal. Option B. Advise the client that any form of aggressive tax planning is inherently risky and likely to attract scrutiny from tax authorities, and therefore recommend a conservative approach focusing solely on standard deductions and allowances. Option C. Conduct a comprehensive review of the client's business model and financial projections. Research relevant tax legislation and guidance for all applicable jurisdictions, and then present a range of compliant tax planning strategies, clearly outlining the associated risks and benefits of each, including those that may be considered aggressive but remain within legal parameters. Option D. Proceed with the client's proposed strategy based on their assurance that it is legal, but advise them that they will bear full responsibility for any penalties or challenges from tax authorities. The correct answer is C. Conduct a comprehensive review of the client's business model and financial projections. Research relevant tax legislation and guidance for all applicable jurisdictions, and then present a range of compliant tax planning strategies, clearly outlining the associated risks and benefits of each, including those that may be considered aggressive but remain within legal parameters. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated desire for aggressive tax avoidance and the firm's obligation to adhere to tax laws and professional conduct standards. The challenge lies in navigating this ethical tightrope, ensuring client satisfaction without compromising integrity or exposing the firm to regulatory sanctions. The complexity arises from the subjective nature of aggressive tax planning, which can easily cross the line into tax evasion or aggressive tax avoidance that is challenged by tax authorities. Correct approach analysis. The correct approach involves a thorough understanding of the client's business and financial situation, followed by a detailed analysis of applicable tax legislation and guidance. This includes identifying legitimate tax planning opportunities that align with the spirit and letter of the law, while also clearly communicating the risks associated with any strategies that push the boundaries of acceptable tax planning. This approach upholds professional responsibility by prioritizing compliance, transparency, and informed consent. It aligns with the principles of professional conduct that require members to act with integrity, due care, and in the best interests of both the client and the public interest in a fair tax system. Specifically, it adheres to the spirit of regulations that mandate professional skepticism and the avoidance of facilitating illegal or unethical activities. Incorrect approaches analysis. One incorrect approach involves immediately implementing the client's proposed aggressive strategy without sufficient due diligence. This fails to meet the professional obligation to exercise due care and professional skepticism. It risks facilitating noncompliance with tax laws, potentially leading to penalties for the client and reputational damage and disciplinary action for the firm. This approach disregards the regulatory requirement to ensure that advice provided is lawful and ethical. Another incorrect approach is to outright refuse to engage in any tax planning, citing the client's use of the term aggressive. This is professionally unsound because it fails to explore legitimate tax planning opportunities that could benefit the client within legal boundaries. It demonstrates a lack of proactive client service and a misunderstanding of the spectrum of tax planning strategies. While avoiding aggressive or illegal schemes is crucial, a blanket refusal to engage in any form of tax optimization is not best practice. A third incorrect approach is to proceed with the client's strategy based solely on the client's assurance that it is legal without independent verification. This abdicates professional responsibility and relies on the client's potentially biased interpretation of legality. It exposes the firm to significant risk if the client's understanding is flawed, leading to potential penalties and regulatory scrutiny for the firm. This approach violates the duty to exercise independent professional judgment. Professional reasoning. Professionals should adopt a framework that begins with understanding the client's objectives and then rigorously assessing the legality and ethicality of any proposed strategies. This involves a risk-based approach, where high-risk strategies require more in-depth analysis and clear communication of potential consequences. Professionals must maintain professional skepticism, challenge assumptions, and document their advice and the client's decisions thoroughly. When faced with a client request that appears to push boundaries, the decision-making process should involve 1. Clarifying the client's intent and understanding of aggressive. 2. Researching relevant tax laws, regulations, and guidance. 3. Identifying and evaluating legitimate tax planning options. 4. Clearly articulating the risks and benefits of each option, including potential challenges from tax authorities. 5. Obtaining informed consent from the client. And 6. Documenting the entire process and the client's final decision. Question 20. The assessment process reveals that a long-standing client, who has consistently expressed a conservative investment philosophy, is now requesting a significant allocation to a highly speculative, emerging market technology fund. The client states they have read about the potential for exponential growth and are eager to participate. The advisor has reviewed the fund's prospectus and believes it carries substantial risk, far exceeding the client's stated risk tolerance and historical investment behavior. What is the most appropriate course of action for the advisor? Option A. Thoroughly explain the risks and potential downsides of the speculative fund, compare it to the client's existing portfolio and risk profile, and then allow the client to make the final decision, documenting the discussion and the client's choice. Option B. Recommend a small token allocation to the speculative fund to satisfy the client's interest, while maintaining the majority of the portfolio in conservative investments, and proceed without extensive discussion of the risks. Option C. Decline the client's request outright, stating that the investment is too risky and does not align with their profile, and refuse to implement the trade. Option D. Proceed with the client's requested allocation to the speculative fund, as the client is ultimately responsible for their investment decisions and has explicitly requested it. The correct answer is A. Thoroughly explain the risks and potential downsides of the speculative fund, compare it to the client's existing portfolio and risk profile, and then allow the client to make the final decision, documenting the discussion and the client's choice. Explanation. This scenario presents a professional challenge due to the inherent conflict between a client's stated preference and the advisor's fiduciary duty to act in the client's best interest, particularly when the client's preference may lead to suboptimal outcomes or increased risk. The advisor must navigate this by applying a robust decision-making framework that prioritizes client welfare and regulatory compliance over simple adherence to a client's initial, potentially ill-informed, request. The correct approach represents best professional practice because it embodies the principles of informed consent and suitability. By thoroughly explaining the risks and benefits of both options and documenting the client's final decision and the rationale behind it, the advisor upholds their fiduciary responsibility. This process ensures the client is making an informed choice, even if it deviates from the advisor's recommendation, and provides a clear audit trail demonstrating due diligence and adherence to regulatory requirements regarding client suitability and disclosure. An incorrect approach that prioritizes the client's immediate stated preference without adequate exploration of alternatives or risks fails to meet the standard of care. This could lead to a breach of fiduciary duty, as the advisor has not acted in the client's best interest by failing to educate them on potentially better options or the full implications of their chosen path. Such an approach may also violate regulations, requiring suitability assessments and comprehensive client advice. Another incorrect approach, which involves overriding the client's stated preference and unilaterally making a decision based on the advisor's judgment alone, is equally problematic. This disregards the client's autonomy and right to make final decisions about their investments, even if those decisions are not what the advisor would have chosen. This can lead to a breakdown in the client-advisor relationship and potential regulatory sanctions for failing to respect client instructions and maintain appropriate client-advisor communication protocols. Finally, an approach that involves delaying the decision indefinitely without clear communication or a plan to address the client's concerns is also professionally unsound. This can lead to missed opportunities or continued exposure to unsuitable risks and demonstrates a lack of proactive client management and a failure to guide the client towards a resolution. Professionals should employ a decision-making framework that begins with understanding the client's objectives and risk tolerance. This is followed by presenting suitable options, clearly articulating the pros and cons of each, and then facilitating an informed decision by the client. Documentation of the entire process, including the client's final decision and the rationale, is crucial for demonstrating compliance and best practice.